Hello, everyone. Welcome to this session with Khetarpal, CEO of Jubilant Foodworks Limited, and Ashish Goenka, the CFO. I'm Amit Sachdeva. I head India Equity Strategy and Consumer and Retail Research for HSBC, and I'll be your moderator for this session. First of all, thanks a lot, Sameer and Ashish, for making this time.
Thank you.
But let's go to it. I have broadly structured the discussion into 3-4 broad areas. First one, near-term demand and margin concerns, which a lot of people have a lot of questions about. Second is the competitive advantages that Jubilant brings to the table and how you deploy that in your battlefield. Third, what is the fine balance of growth and profitability you're after? And again, capital allocation and some sustainability. So that's a broader, but we'll be open to questions from everyone as well. This is a Q&A format discussion, everyone. So please submit your questions in the Q&A bar, and we will take the questions as they come. But let me start off by asking Sameer. He's joined you, and he's looking things from all angles. Sameer, why don't you share with every one of us with your background, what excites you, and what unique perspectives and capabilities that you bring to the table, and what are your key focus areas?
Wonderful. Thank you, Amit, and thank you, investors, for joining us today. I'm truly delighted to interact with you at least soon within the first 6 months of my journey, and look forward to an engaging conversation today. So about me, I'm in my 25th year of professional life, 50th year of since birth, and 25th year of this company, right? So I somehow feel that it's very opportune. I come from a very humble background, grew up in a house shared by 16 families, therefore feel very blessed, and I'm an eternal optimist. Professionally, 25 years, started with hardcore manufacturing of ice creams. I commissioned the ice cream plant in Nashik for Hindustan Lever, therefore understand the food space back in 90s when there was no cold supply chain. I moved to services business thereafter in GE, where I was part of the big outsourcing offshoring wave, and ran a team of nearly 1,000 people across 4 or 5 countries, learned the hard part of people management, distributed teams. Then it was 9 years or nearly my 30s spent in McKinsey as a consultant, where I worked on multiple topics of strategy, sales, account management, operations, but more importantly, driving performance. Then last 7 years was again very unique with Amazon, which was building very tough businesses like food, grocery, healthcare, understanding the retail landscape. But the most important piece over there is how do you bring customer back inside, data technology, and hard execution. So I'm delighted that all of this is culminating right from what I learned in a small house when I shared a bathroom with 16 families to right over here, building some India's probably most loved technology company, and now at Jubilant, opportunities galore. So very delighted to be here.
Thank you so much, Sameer, for sharing a very inspiring tale. We'll obviously, take notes in detail as well on that later. But let me just, ask you also that if you could narrate that what you've seen so far, what are the 3 main targets that you have kept for yourself for next 3 years?
So at Jubilant, I think again 6 months is not a long time, but time enough to start forming a path forward. Mm-hmm. My initial time was spent in visiting nearly 200 stores, speaking to nearly 1,000 customers, mm-hmm. and also equally our own frontline employees, which are the true conduit between or the closest to the customers. Having said that, I think my first task was to accelerate what we have, learn and accelerate. But when I look forward, Amit, this company is actually sitting on a gold mine. Mm-hmm. And I will talk about it as our conversation goes forward. There will be 4 pillars of acceleration that drive our strategic agenda in terms of having industry-leading growth rates and industry-leading profitability.
Sure.
And these four pillars are customer first and customer and market first, where there is, again, we can talk more about it. I think again with data technology, it just comes to life.
Mm-hmm.
Therefore, the second piece is data and technology forward.
Mm-hmm.
Third is we are in the business of delivering a great product fastest to the customer, which is freshest, hottest. We are there to delight the customer. Therefore, operations excellence will always be our pillar. And fourth is that I know you will have questions on from the past, what happened and where are we moving. But good to great journey is embedded in a deep-rooted culture and the people that man the post. So these will be my four pillars. All my answers, everything you will see, or I spent 90% of my time on these four pillars, and this will be the core part of my strategy.
Excellent, Samir. Thank you so much. That was brilliant. So wish you all the best as you execute your strategy. But let me come straight to the basket of issues that I sort of spoke about, and this is again come from various investors and just of my issues. I've sort of spoke a few, and these are some of the issues which are obviously in everybody's head. So let's just straight go to it. First is basically demand and margin issues. Like really SSSG, or like the growth you may call it, has decelerated very sharply in Q3. Right? It is so one is that to sort of understand from you what are the key issues underneath, why it has happened. It's probably cyclical, but how soon you believe this could start to normalize. And as such, you want to take the growth to 5 to 6%. What will be the key drivers and how you're addressing and mitigating the near-term demand challenge? And once you answer that, I'll probably blend into the margin issue as well. But why don't I just focus on the like-to-like growth and the issues underneath first, and then we'll follow up with that.
Sure. Ashish, do pitch in. So as I see, I think my understanding of the macroeconomic pieces, of course, we are in a decadal high inflation rates. We have carefully and thoughtfully taken price increases, right? And after COVID, there has been structural shifts in demand.
Sure.
Right. So therefore, in the short run, we are seeing some of these patterns kind of playing out. But let me assure you that despite these headwinds, I see actually tremendous opportunity on three dimensions. Number one, our loyalty is firing. It's working. So our high frequency, medium frequency customer base is ever increasing. Second is habits have shifted materially from ordering in home versus going out, though indoors coming back. And I know I spoke about dine-in as a growth vector too, but our credentials on delivery and moving from 30 to 20 will again, I think we will stand out for our excellent delivery credentials. Number three is our store network, right? And at 17661 stores, 387 towns, we have access to consumers in no versus the competition, which is truly, I think we are the neighborhood store.
Sure.
We've always stood for value for money, backed by our high throughput of our stores, commissaries that we've built, and the logistics prowess that we have. So when I combine these four, value for money, neighborhood store, loyalty, excellent delivery, I think it is up to us to kind of execute. I see therefore, I mean, more internally, how to tap this growth. We are still at a frequency of 3. That is the reality, right? And when you look at some of the Western geographies, even Southeastern geographies, they're far higher than that, this number. So I see it more as a natural expansion of store, thoughtfully done. Improvement in service led by digital and technology that should increase the frequency as well.
And of course, value for money.
Value for money checks out
And that you also refer to loyalty being firing. Would you elaborate on that, please? That what is the contours of that statement that you made?
So I think we crossed 1 crore loyal members last quarter, right? And that's quite meaningful. And in fact, if our internal research also says that it is working very well with our consumers in terms of loyalty program that exists in the world of food, right? I mean, right. So the Cheesy Rewards as a program is just in 7 months of inception is hitting the minds of the consumer.
Sure.
So I think, and that is a great hook in today's day and age when we are omnipresent, right? Here is a digital tool or digital product that we launch has very quickly reached an adoption of 1 crore, right? And we are seeing more and more number of orders are being, because you can order anywhere, but you have to burn on our app. So that drives traffic, that creates assets, and that's why I think loyalty is a core member. And this has also been, it is panning out in US also. You would see how Dominos US has used this particular product and grown in a very competitive environment.
Also, just to add to what Sameer said, I think there were twin objectives of us launching the program. One, how do we drive frequency up of our existing customer cohorts? And second was to reduce churn. Because in our category, while the frequency is low, the churn also tends to be very high. So of course, initial days of the program, the frequency will play out over a slightly longer term period. But we are already seeing a uptick in frequency, though very marginal, and a reduction in churn. Okay. So the two key reasons why we launched the program already seem to be tracking well.
That's good to hear, Ashish. Thank you so much. But then, which means that we are some of the building blocks of going towards 5 to 6% that Sameer talks about. As the demand cycle normalizes, inflation, etc., macro issues sort of settle down a bit. These are the structural building blocks that you are building to spur more. If I paraphrase what you said correctly.
Yes, I mean, it's still, I look at it like this: it's a $45 million market size, about $4.5–5 million of QSR. I think the opportunity is just so immense, right? As movement happened from unorganized to organized, right? And as we launch our 49–50 rupee products, right? I mean, samosa or a pav bhaji, right? I mean, that's what the space that we can compete with versus gourmet pizzas, and right. That's important. We'll not leave that segment, but really the mass. We are here for. I'm here for growth in the category, improvement in penetration, and that is what we have already started taking steps towards that.
Excellent, Sameer. So we'll talk about that value innovation of yours of 49 rupees in a bit, but let me come back to Ashish and you again on margin side, because I think, well, the near-term demand appears to be challenging and you are taking some steps to mitigate it through value offering, but input prices have risen further in Q4. Yeah. Q3 they rose, but I would gather that Q4 the trend has been incessant. So, and while in absence of any price increases, well, one can, and amidst weak demand, one can again fathom that margins may not have bottomed out Q3 and the pressure may continue. And what should be the near-term dynamic on margin that will play out? And if the 75% kind of margin which we saw last quarter, it seems to, if I were to take a long-range view, probably it's a new normal. Your 78 was a normal high margin, but this is the new normal you are sort of comfortable with. Is that how we should think about it? But if that's the case, I would probably argue that not just coming quarter, but next 3 quarters would continue to see margin being somewhat compressed at the cost level. I mean, I'm sure you can mitigate it through other means, but theoretically, the picture does seem a little bit challenging to margins. How do you react to that?
No, you're absolutely right. I think we are seeing almost unprecedented level of inflation. And any prognosis that we had in terms of when will and what time the commodity cycle should play out have actually turned against us in that sense, because Q4 is typically the quarter when you see softening of the cheese prices.
Sure.
But it's really not happened. There will be some moderation, but not to the extent you would have expected. So if you see, there are broadly 4 contours of how we look at gross margin. One is, of course, pricing.
Mhm.
And as you're rightly saying that, given the constrained demand environment, I think pricing would be limited play.
Sure.
But we are looking at mix very closely, which is the second parameter. And that's why on one hand, we have the Viva Roma range that we have launched, the gourmet pizza. And within the portfolio, how we can drive up uptake of higher margin products.
Sure.
What I also want to clarify here is that despite launch of low margin products, our margins across all our products are by and large similar. So the product mix does not impact us on the low end, but of course it gives us a higher end of the portfolio. So we continue to drive out the mix. The third, of course, is how do we play out in discounts, because discounts have a direct bearing on gross margin. So we have been again very select on in the way we deploy discounts. Of late, of course, we have been wanting to pass on more value, but that is one equation we would look to correct over the next few quarters. How do we get more tighter, more digitally, savvy in terms of the way we deploy discounts and in a more targeted manner. And the fourth, which is a joker in the pack, is how the commodity prices play out.
Sure.
My sense is that commodities, by and large, in terms of pricing, would have almost peaked out by now. We are already seeing some softening in oil prices, in box prices, which is largely paper prices. Oils have come off a bit. There is some hardening of flour, which is again for reasons we know, and cheese, which is the largest input that we have in terms. So if we do not see any further hardening from here, we should be able to sort of maintain. But yeah, it remains a little tough, right?
Fair enough. So I think margin is something to watch out for.
Yes.
But again, retailers' margins are not just gross margins. It's how revenue throughput pans out as well.
Yes.
But I would also argue that one may also argue that since you in the last 3 years variabilized a lot of your cost structure, especially on the employee side, things have become a lot more variable.
Yes.
Which on the adverse effect in a time like this, there's not much to cut. So you can't optimize. It is already on a variable footing. So in some sense, it leaves you very little wiggle room. So you should hope for many things to sort of play out your way. But at least it sort of seems clear that near term seems a little bit of rough patch.
No, absolutely.
Is it a fair understanding?
Samant, I will just make a small correction to what Ashish said, or to allow me to counter a bit. I've been a consultant for 10 years. I think there is always a war on waste, right? And we will get that war on waste right? And we've already launched an initiative internally that as we get into one quarter, we want the initiatives to be rolled out and fleshed out. So there is, and I use this classical training that I've had on industrial analysis, that if my bottom quartile stores, not on revenue, just on cost, adjusted for revenue, were to move to the next quartile, that is itself is a large amount of money.
Sure.
Right? And as you know, so these cost is in manpower, while it is variable, right? But are we matching demand and supply? Food cost, making sure that we have zero wastages in our stores. LPG cost, electricity cost, right? The petrol cost for the bikes that we use. So again, there is what I get on the margin front. Again, there is a lot of opportunity in terms of what we can do in terms of recipe optimization, reducing wastages, using technology to pass on sharper discounts, reducing our promotion burns without impacting revenue. So again, there is a lot of opportunity that I see in the P&L.
But you won't probably resort to pricing as a tool to mitigate it. Is this something that you're alluding to, that everything else will be tried and hope that the price is correct? But there's a bit of a fear, or if I may say, a bit of a reservation, even not just industry-wide, whatever comment you've heard. Nobody always seems to touch pricing. Is it so price elastic that demand is that you would probably not touch pricing?
I wouldn't say, more than elasticity of demand. See, we've always stood for a value for money offering. So we would rather continue to pass on that value, especially in times where they are themselves constrained because of high inflation. So I think in the long run, we would rather have customers who are on our platform engaging with the brand, because the lifetime value that we can extract from a customer who is onto our brand is far higher than the short-term value extraction that I can do through our pricing. I think so that has been a guiding philosophy and belief for me.
Yeah, I think the thing, just to be clear, I think in the last 3 years or so, we did initiate the delivery charge. Sure, right? And that was one big move. We also took very calibrated, almost 3 price increases in the last 12 to 15 months. Sure. So I think we are not afraid of doing that. It's just that it has to be calibrated with make sure that my overall customer base grows, their share of wallet shifts with us. Sure. And then and using that as, I would say, as a lever very surgically, where we know this is the right time to do it. So we're constantly monitoring. We have the data models, we have the learnings from the past, how much flows in, how much doesn't. So we will be very thoughtful about it. And at the moment, at least in the next 2 to 3 months, what I can say is I'm using more internal levels to get money out of the waste rather than passing the pricing to the consumer.
And one other thing which played out well for us is, despite these price increases, in the last 3 quarters, we have actually seen all order-led growth and very little price-led growth. And I've said this in all our earnings call as well, that consumers have been calibrating and reducing or downgrading, but they haven't left the category, or they have not given us price, which is actually always well for us in the long run. And that is why if you see all the consumer metrics, whether in terms of the MAU that we have on our app, the engagement level remains very high.
Okay, got it, understood. Great. So let me take you to now, basically network rollout logic and competitive advantages, the long-term capture. So, one, I always wanted to ask this, to be honest, but since many people have asked this, so I'll not take the question as mine, but several others who have sort of asked the same question, is that what is the key reason that network rollout target was so brought forward and compressed in a short period of time, became very aggressive? Was it competitive responses that everybody's doing it, so we might as well do it before? Or as it happens that, if my SSG growth are slowing, because we know the period of 2013 to 17 where growth came, but SSG declined and margins declined, and the period of 4 years had zero profit growth, despite the revenue growth was 16% CAGR, if I were to remember that numbers correctly in the period. My sense is that, that fear comes that, this aggressive network rollout, at least a lot of people would cynically be circumspect in saying, is it because economics look tough, so let's just build network? And it is clearly showing on your negative PBT drag, because that shows that PBT is growing slowly. Why grow so fast? Why not grow at a virtuous pace, which gives you not only just revenue growth in a structural, sensible way, but profits are also ensured at the same time? And that looks much respectable framework for growth rather than having to lump capex or at least store expansion in such a short period of time. I don't know what's your reaction to that. In my sense, that is a little bit of issue in understanding how growth strategy is panning out. Or you want to sort of guide us how you're thinking about it? Is an old understanding, whatever you please feel free to sort of.
Yeah. So we've taken several learnings from the past. Mm-hmm. Right? And I think the system has that muscle memory of not to make those mistakes. Sure. Now let me illustrate why I say that. So firstly, we are not wedded to a number, okay, particularly, right? We are wedded to ROI per store, payback periods, and the EBITDA it generates. Sure. Right. So those are the markers we keep. We have a very strong. Firstly, how do we identify a store? We have an analytics and insight model which predicts the sales for a region that we want to open a store. And then there is a very rigorous process of looking at the site, evaluating it, negotiating, making sure we keep our capex control, having 3 rounds of discussions to approve a site or not. Mm-hmm. Right? So one thing I want to assure you is that we evaluate every store standalone on its own merit, keeping payback periods and EBITDA it will generate as the 2 primary dimensions. Sure. And And we are not wedded to any particular number, and we'll of course evaluate it when the time is right. In terms of when we get into our strategy session, we will. If there is any change, we will come back. There is. The second piece is the. I think we have the back-end strength through our commissaries, logistics, cost control, to serve these cities, be ahead of the competition, serve these cities or new towns, and still have the same level of capital efficiency and the P&L EBITDA that we generate. So these stores may be lower on throughput, but they're lower on rentals, lower on manpower cost. We get leverage of our marketing costs, the ATL campaigns we do.
Sure.
So it brings in a lot of goodness to us. And of course, we are building these stores for 10, 11 years, right? And the payback periods are still very, very lucrative. We have, in fact, our payback period has remained constant or marginally improved in the last couple of years.
Got it. That perhaps explains why revenue per store looks stubbornly resilient, because the marginal stores may bring in lower revenue, but probably they're on ROI basis, there's no difference. So there's a value capture happening, but optically it gives you a sense where store is resilient and or at least stubbornly stuck at that number of. Is this the correct understanding?
No, absolutely, and I've explained this in the past also, that there are two factors that we must consider when we look at our APS. One, of course, is the fact that we're making deeper inroads into tier 3, tier 4 towns, which again, in terms of ROI and profitability, are at par with the stores in the tier 1.
Sure.
And the second is the fact that we've been splitting stores in tier 1, and not for fortification and for various other reasons, which also optically reduces the APS. And that's why we started reporting LFL APS.
Sure.
That should give you a little more better color in terms of how APS is going.
Got it. So take you from that, I think summarizing what Sameer said, that one is that the lessons from the past have been well documented, and there's a rigorous evaluation that goes for each store. It's a standalone business opportunity, which is evaluated as if it's a standalone business opportunity, and then all the aggressive bits are inflicted on it before anybody says yes to the store. Yes. And it has multiple rounds of evaluations, and then finally, so that process stays.
Absolutely. And I think one more very important lesson that is, I think, embedded in the DNA is never take your eyes off LFL growth.
Sure.
Because I think anyone in the company is not getting a revenue growth.
Got it.
Revenue growth is an output of what we do, but I think the targets that we carry are largely linked to LFL growth. Because that is, I think, absolutely a lesson that we learned from that phase.
Sure.
Like you cannot just keep driving growth without driving LFL growth.
Understood. Ashish, thank you so much, Sameer, for this answer, because this was, I think, a bit of confusion in many heads. But I would also probably, now we talk about capex store, and Sameer mentioned commissary as well, but I think let me just relate it back to commissary capex, which, it's a very big shadow capex that happens in the background, and I would probably, say that some people manage without that capex, So I would probably ask Sameer and you is that then some competitive advantages that massive capex brings to you that is not replicable or managed by others. How much, when you do this cost benefit analysis, make or buy, what sort of advantages that you drive from that capex that you believe that it is, or why not spend that capex in consumer centricity, build more stores or do some product quality or whatever? Why go build a back end which is such capex career? How do you justify that cost benefit, and could you share some anecdotal evidences that this is money well spent in something?
So I can start and then Ashish, please chime in. So I think we make the same margin at 49 rupee pizza at the gross margin, right? In terms of 49, when we launch a 49 rupee pizza, we get the same gross margin. And the reason is because we have a very solid backend.
Sure.
Right? And when I say solid backend, it is the process of sourcing. It is also the process of conversion and forward logistics from there.
Sure.
So it brings in those efficiencies, right? And versus if we were sourcing for different places, asking somebody to, we'll have more number of trucks coming into the store, we'll be spending in consolidation, we will, and equally our fill rates are above 99%, right? Which is in fact, the best that at least I have known in India. And so we have like zero store closures or zero store shutdown because the material was not there.
Sure.
So I think it gives us that advantage of opening stores and then forgetting in terms of would be able to supply very reliably on to them. It keeps a very high bar on our safety standards, food safety standards of quality and temperature control that we are able to do. It also helps us play on our ESG commitments, right?
Sure.
Because we source from from antibiotics-free chicken. We know where that is coming from. We process it in-house. We make sure we are not using any artificial colors or preservatives.
Sure.
So it just brings the whole story together for us. When we deploying capex, again, the rules of the game are the same. What is the ROI? What is the payback period? Right? And then what are the aspects to be, and what is it giving? What is it giving to the customer, and what is adding strategically to our business? I think again, having visited to some of these factories, and I would encourage some of you to go see these factories. I think you're just seeing is believing, and you'll get convinced. Because in India, at this scale, the supply chain is broken.
Sure.
Right. Therefore, all big companies, they invest in their own capacity, and we are taking very thoughtful decisions where what we will outsource, what we will buy versus what we will build. Again, a very careful evaluation is done, and these assets pay for themselves.
Got it. No, I think thanks so much. You have highlighted many competitive advantages, whether it's emanating from scale, delivery capabilities, digital assets, and brand, obviously, which brings in the trust in the consumer. But, I also recently noticed that you went out and launched a 20-minute delivery across various of your markets, not probably entire India, but some selected markets. Now, interesting thing is, it's a clear push on capabilities that deliver in 20 minutes. It has implications for delivery staff, it's an implication for kitchens and process and everything. One, how did you manage it, and how scalable that is? Would you be able to roll it out to entire markets? And where it has been implemented already, can you quantify? Has that resulted in some change in consumer behavior, or you started seeing revenues being, throughput being better in those markets? Because at the end of the day, it should result in consumer delight and willingness to buy and pay. So where do you see that change, or it's like a marketing innovation, but it is, it needs to sort of reflect on how consumer franchise is building on it. So any reaction to that?
So it is not a marketing campaign, it's a hard consumer benefit. That's how we see it. And we have been preparing for it for the last 3 years.
Sure.
The whole fortification, densification strategy was done to give a better service, greatest, freshest pizza, tastiest pizza, fastest to the customer. And this program is places where we have the network where we can do it, which is in top 6, top 7 cities. That is where the consumers are looking for more convenience.
Sure.
30-minute delivery has been democratized by aggregators. This allows us to really, I think, rather than more versus aggregators, but versus in favor of our consumers, where a pizza box never leaves our hand, right from the start to consumers' door. It allows us to wow the consumers.
Sure.
And I commute from Gurgaon, and when I joined, the stores were struggling over there in terms of their delivery capability. The moment we started pushing on this dimension, growth rates have doubled. So I clearly see that if consumers will come back when you offer them a great service. And given our reliance, like 2/3 of orders are online or delivered, right? And this is a chance to wow the customers. Backed by loyalty, that becomes like a flywheel in itself. So great service, value for money, delivered in 20 minutes, it becomes like a flywheel for our business.
So a bit of a like all scenarios favorably placed.
Absolutely. And therefore, I think long term it becomes a competitive advantage.
Sure.
And I think that's how I want to see this. In isolation, you may see, okay, it's 20-minute delivery, so what? Right? But you see loyalty, 20-minute delivery, store densification, value for money, then it starts playing like a moat.
10 minutes is a lot of time in food delivery because food gets older by 10 minutes. much less eatable than a fresher food. So I see that there's a bit of an advantage here. But given the scale up so far, do you see it is scaling up to larger footprint, or it is still at a pilot stage, or how you see over 1 year period it would be like a national phenomenon? How one should see that service, or is still metro centric? Or
I think it will be largely where consumers want it. I think it will be more metro centric, and I think our dining mix is different from top 6, top 7 cities versus tier 3, tier 4 cities.
Sure.
Right. So where consumers, where we are the first QSR, consumers want to go dine and take their family, versus where in metros we are a known brand and consumers open the app and order it.
Sure.
So I think we will again, it is like I said, it's part of our fortification densification program, and wherever the catchment allows us, we will offer it to consumers, and where consumers want it, we will we will give it to consumers. So I think it is not a national program that way. Sure. It should give us the competitive advantage in the regions we are doing it.
Sure. Understood. So that's very. Are we seeing more questions as well? So I will probably continue with a couple of more, and then we'll go to the live questions as well and address a few of them too. But one thing I want to just distract you a little bit to a very abstract question. But this is abstract in the way that, because every product has a value proposition. Every taste, preference, quality, aspiration to, it is convenience or, where I crave for it. A variety of food offers us different value proposition, pizza being one of them. But we've seen like a like-for-like growth also coming down a bit, if not this quarter, but it has been a bit of a trend which is still, and COVID had a tailwind. It was a trusted quality food and everybody find it very easy to order. Is the value proposition somewhat challenged? If, for lack of a better word, weight. How do you see it? Do you see that when you slice your markets, top 10 cities, 4 metros, tier 2, tier 3 towns, and some cohorts like, for example, IT, which are facing some challenges of job losses or at least salary being low. There could be a variety of reasons. Do you see some cohort-wise, some interesting trends that you could point out for us, that how one could find conviction that the growth is here to stay? While top numbers of 10% or 45 billion, it's a great opportunity. Theoretically, if you look at US market of last 70 years, 50 years, it continues to evolve. So one can find conviction that these markets will grow for a very long time. But in the near term, do you feel some category headwind as such, or do you feel it's very cyclical and it's inflation linked and we need not worry about it, nothing structural about it?
I think I don't see anything structural except for near-term headwinds that which will be there largely now on account of inflation, right? Where consumers are making sharper choices to protect their wallet and looking for some entry-level price points, right? I mean, and sure. Therefore, again, I think Domino's being always a value-centric brand, I think it presents opportunities to that extent, right? It's kind of ours to capture.
Sure.
In terms of category, we are a very food business, right? Even if my mother cooks the same thing every day, I would want a refresh.
Right.
Having said that, we have the team. We have a team of great chefs. We have a team of great culinary science. We have all the kitchens. You are sitting in our office. You can see above the kind of infrastructure that we've built, right? And therefore, when I say customer and market first, one of the themes in that is many India. Right? We launched Parantha Pizza. We launched a 49 rupees Desi Videsi. We also launched a 600 rupee gourmet pizza.
Sure.
From the same kitchen, same oven, using the same ingredients. We will innovate for East, North, West, and South.
Sure.
Right, and bring local flavors, because in South people love to have more spicier non-veg. Right, so I think our network allows us to have like a unique for 150 to 100 odd stores in a particular state. We can launch a Gangora chicken in Andhra Pradesh and Telangana because we have the store density. Unit economics work for us,
sure,
and that is what the local tell us. So I think so there is, what I'm saying is, consumers moving towards value, we are there. We will innovate on the menu, and we're on all three formats of or channels to be consumed.
Got it. Got it. Let me, thanks so much for this. What you're essentially saying is that value proposition creation is on us to excite consumers, and you are expert at that. You have the resources and the scale to affect that change. Point taken. Let me go back to the web questions because enough on my side. So one question I would like to read is from for Popeyes, will the network rollout story be similar to that of Domino's? What elements of the latter's model are you looking to replicate in the chicken brand? Also, any comments in the fried chicken opportunity given it's a lesser crowded market than pizza?
Indeed, it is a great opportunity. I think that's why we very carefully chose Popeyes. And we have seen Popeyes country after country kind of becoming the brand that consumers love. Its bold Cajun flavors actually work very well with Indian palate. And yes, I agree, it's a less crowded market. And in fact, I was speaking to one of my friends and I pointed out to him that when have you gone to even a fine or casual dining restaurant eating fried chicken?
Right.
So therefore, it is in a sense a unique opportunity. We have done two things very successfully up till now. One is to make sure our taste is consistent. We have great feedback on food quality, food product. We are sourcing antibiotics-free chicken. We are bringing a lot of these processes in-house in terms of marination to control cost and to control taste and the food safety. And I think we are ready to scale.
Sure.
Right? I think gives us the confidence, and you would have seen the lines outside, whether we opened a store in Koramangala or in HSR layout, or recently in Market City Mall in Chennai, right? The response is tremendous. And so therefore, from that perspective, I think some of the hard work of building the category basics has been done.
Sure.
And the discussions I have internally with my own team is, why are we not opening stores fast enough? So it's less about the demand, more about the supply. Of course, we'll always be very thoughtful in terms of where to open the store. And I think we are chasing 250 odd stores. And I think we should get there, and in terms of because the back end hard yards have been actually done to carry the momentum forward now.
But would you believe, Sameer, that the margin structure on a steady state would be as good as Domino's, given probably it's a higher throughput, slightly lower margin category, or how your initial hypothesis about the scaled-up model, how would it look like?
So, Amit, I think we know the category margins in this category. There is already a established threshold. So I think in the fullness of time, EBITDA margins should not be very different from where Domino's is today. Of course, the gross margin profile are going to be different because the categories are very different by nature. But we believe that in the fullness of time, we should get to the category margin and then improve from there, because we have the competitive advantage of having the scale, the same commissary, the same supply chain network being shared across both the two brands. And I think just to add to what Sameer was saying, and those competitive advantage, we are now bringing into Popeyes as well. Media supply chain strength, these are digital strength. Popeyes was the only brand in the world wherever Popeyes have launched with its own app on day one. Because we had a digital strength in Domino's that could be extended. Similarly, the execution, the brand development, the projects team. So the entire backend is getting shared, and gives us more confidence that we should be able to scale it much faster.
I'll actually ask, Lakshya to read the rest of the question.
Yeah, sure. So we have the next question from Saurabh, where he's asking, why is it important to move to a market ahead of competition in terms of either the customer traction, taste, or user acquisition? Because we have always maintained a gap of almost 150 cities where we are the only QSR present. So the question is largely why it is important to move to that particular market first.
So I think these cities, and I've visited a few, and last quarter we opened a store in Vidisha in Madhya Pradesh. And I was kind of skeptical when I was getting approvals for that store, but on I think 30th or 31st, I got a call from a customer at 11:30 p.m. in the night that I am waiting for 40 minutes. I have not gotten the pizza. I can't even enter because there is a big line.
Sure.
Right. So I think these are very encouraging signs. While I want to serve that customer, I was disappointed that the customer had to wait to get inside the store. But this is the opportunity that these towns offer. And as India builds more highways, as the income disparities reduce, or rather, I would say there's flow of incomes and capital towards these cities. I think it is important for us we invent the right model, right cost structures for these cities and be ahead of the market.
Sure.
And it's not that we're going to open 5 stores in a town like Pradesh. We'll open 1 store and we stay put for a couple of years till the time we see that, okay, now the stores are bursting at the seams. Right? I mean, there are several such stories where, be it Bulandshahr or Moradabad, where we give approvals to expand the number of stores because the other stores are bursting at the seams. So again, the process is very rigid and tight, and that we always go in. Okay, this is a new town. Our algorithms are telling us it will generate the revenue that we expect from a store that it should. Payback period is there. We do it, and then we see the results, and then go to the next one. So I think it's very scientific in our approach.
Sure, sir. We have the next question on reimaging. The question is, what is the additional capex you would require for reimaging program? And what are those element of changes which we are doing by the reimaging to the ACE design within Domino's? So will it be a large additional capex which need to be made for this? And what is the quantification of the stores?
Yeah, I think in my assessment, I think firstly, a part of it is always a part of the process, right? We relocate old stores where rentals have gone higher and the customer or the dining proposition is weak, right? So it is not something that new. But yes, if there are stores where the competition intensity has increased and we have not spruced up our experience and the changes, these are not more than 10-15% of the store, by the way. Because large part, like almost in the 2 years, whatever 500 plus stores we would have opened, those are anyway new design, right? And we are looking at some of the older stores which are lower in terms of percentages. And over there also, I think there are 4 sets of changes. One is only dining area changes, change the furniture. Then there are the next level, which is minor modifications where we change the furniture and the walls. Then there are medium modifications where we spruce up the AC and some of the dining area. And then finally, there is a full reimaging. So that number is in the tune of 10 to 15% as we look at the overall stores broken into all 4. But there is no additional capex we'll manage within the capex guidance. It's just that doing it timely is more important than the capex part.
Sure, sir. We have the next question on the growth within the pizza category. Is the pizza category very cluttered in terms of the network expansion, even by the competitors and Domino's own network expansion in the past? Given the high penetration of stores, is mid-teen growth even possible for a company like Jubilant Foodworks and Domino's?
So I did allude to it. 45 billion market size, $4.5 billion of QSR category. So I think it is still significant headroom, I would say. And I mean, the reality is Domino's in US continues to grow, right? I think they have like far more number of stores per capita, right? And I think we are scratching the tip of the iceberg over here. Again, we have to be prudent in our expansion. So I see more about execution, tapping the opportunities, having the right capex model, inventing on behalf of customers in terms of menu choices, value for money, doing the delivery excellence. Huge headroom, right? I mean, we are 12 million monthly, less than 12 million monthly active users. Swiggy, Zomato, and other combined are more than 150 million. So we are just too small in the overall scheme of things. That's how I see it. It's more about execution than the demand opportunity.
So the next question is on Hong's Kitchen. Indie Chinese category is very popular and it's the large part of the supply chain still remains fragmented. What are your views on Hong's Kitchen and what is your ambition here?
Yeah. No, I think I had to take a tough choice. Like when we did kind of move away from Ekdam, right? And the answer was also partly in Hong's Kitchen, which was doing quite well, right? And if you look at you can open up Swiggy or Zomato and look at the customer rating and the feedback that it is receiving. So we worked very hard on changing the recipes, making it more Indianized, fixing the supply chain, going back to our commissaries, taking a lot of those back-end processes or consolidating those lot of kitchen processes into our supply chain so that we can give a very consistent quality. Again, our store format, store designs, we worked a lot on it to how do you do the right throughput in a 1,000 square feet store, have the right balance of dine-in plus delivery and takeaway, again using our own app. So those are the core element that we're all building all businesses upon. And yeah, I see it more as an opportunity. At some level, it can be even bigger than chicken because at least in chicken, you can name a competitor. In Chinese, you can't even name a competitor, right? Which is cross 100 stores, right? So and as a food company, the largest QSR company, I also see it I take it as a matter of challenge and also pride that we have to have at least one homegrown brand. So, and here is our answer on Hong, but we will be very prudent about it again. We will treat it as a startup, do it in a sandbox of 14, 15 stores, prove out the economics, get the food cost right, have an awesome, lovable customer experience, and then fire.
Sure, sir. We have the next question on loyalty program, which has partly been addressed. It has started well. What are your ambitions here? And I think we have covered that in the response.
Only double down, right? We will not give any. I mean, it's a source of strategic advantage, so I will not comment on it. But the idea is to double down.
Sure. Next question is on the capital allocation going forward. In the last few years, we have seen Jubilant entering multiple cuisines beyond pizza, and while pizza as a category offers significant large opportunities, all these categories also address a larger audience. But we also have expanded in Sri Lanka, Bangladesh, and have acquired stake in DP Eurasia. What is your thought on the capital allocation, and secondly on geographical expansion? How do you see that happening?
Yeah. So I think in terms of capital allocation, I think the priorities are very clear. First, if I had 1 rupee to put, all of it will go to Domino's because we will not start Domino's or more. Second, we've called out Popeyes as the next big priority, and therefore between Domino's and Popeyes, bulk of the store expansion capex will go. As Samir said, some of the other brands are in the sandbox. We will only invest if we find a model to be profitable and scalable. The third level of investment would be in our back-end supply chain. And as I alluded to that, I think they're getting into a slightly higher capex cycle because the step investment, we have Bangalore commissary is getting commissioned. It's a 50 crore investment, and probably Mumbai will follow after that. So we have a bit of a higher capex cycle coming in terms of our commissary spend. And I think beyond that, it will be some very small strategic investment depending on whether the opportunities are attractive or not. But I think that is the basic framework that we follow. Domino's, Popeyes, commissaries, and some of the capabilities that we are building around digital.
Sure, sir. We have last 5 minutes, so I'll take probably the last question and then hand it over to Amit for closing. What happens when any competition across category in QSR opens a store near to your Domino's store? Have you seen any adverse impact on your revenue throughput or anything which you can share?
In fact, Samir can add, but in fact, it works the other way around.
Yeah.
We always go to a catchment which has higher throughput, higher footfalls, and where there is a concentration of QSR brands. So those places actually attract the highest level of footfall. So whenever a competition or any other QSR is in close proximity, the throughput from the store over a period of time actually goes higher than actually going down. And that's why most QSRs actually follow each other as a strategy in terms of their store expansion.
Yeah, I think like for like in a mall where you have all the competitors, right? Domino's tend to do one of the best, right? In a mall where So in a food court of a mall. So I think same logic works actually in our favor.
That's right.
If I may just squeeze in one
Please.
Basically, Prashant asked, Domino's did the best when Pizza Hut was too focused on dine-ins. While Domino's cracked the delivery opportunity, seems the strategies are reversed now. How do we ensure that our focus on dine-in does not reverse those gains as Pizza Hut is expanding more for delivery outlets?
So I think we will excel in delivery through 20-minute delivery, which is our own delivery unmatched and our own app capabilities, okay, which is all towards delivery and loyalty, of course. So so I don't think there is any drop in focus, intent, investment, capital on the delivery side of in fact, we're only doubling down even more, right? I mean, in terms of the leadership bench strength I'm creating, it is only large part is good. I think we have these stores, right, which is the neighborhood store. And COVID did kind of reset the base. It is only natural to get our humble right share in those neighborhood stores, so that whether I'm coming back from office or a school, I visit these stores outside near every store has like a school nearby. A little girl will bring her parent or mother, can I have a pizza? Right? And those are the joyous moments that are created inside the store. Or somebody celebrating their birthday in a location. Homes are small, and this gives us the opportunity to celebrate and be part of daily lives, which is inside the India.
Got it. With paucity of time, I think you have a schedule on you, and so I would be cognizant of that. So it's 4:28. So I can just ask you about one common theme which we ask everyone. The sustainability things that you talk about is what sort of material changes that you are making in Jubilant that you are proud of?
Yeah, I think good thing is you have the ESG leader sitting in this room. Starting this is very important, right? So how we view this. Each department is carrying a target on I think 3 dimensions. One is sustainability of food. Second is the use of electricity, solar power. In fact, we launched a big campaign internally on how to move quickly forward on that dimension. And third is emissions. Right, and Popeyes, for example, is 100% of the bikes are e-bikes. And we have the same intent and commitment on the Domino's side. Like all new stores open in a hilly area, they all open with e-bikes. And if the capacity of e-bikes were there, we would have in fact converted all our bikes to e-bikes. So I think it is again on all 3 dimensions: food sustainability, energy, and emissions. We will push forward, and it's part of my goals and the KRAs of my team. You want to add?
The only thing I add is that I think the way we do sustainability is not a project. I think it's very integrated with every part of the business, and that's how we approach the whole ESG agenda. Of course, we will be putting more formal targets, but it's already very well embedded in the business. So whether it's the antibiotic-free chicken or the solar power that we're using in our chemistry, almost 30% of our fleet is now e-bikes, or reduction in energy waste management system across our stores. So it's pretty much part of the way we run the business.
Great. Thank you so much, Sameer, Ashish, for generous time, sharing your thoughts with us. And I hope it gives us some clarity and how you are taking the business forward. I'm sure it is one of many interactions which will happen in the future, and you'll continue to sort of update us how you make progress on the priorities. I also thank all the participants for being here, patiently being there in the webinar, and while asking questions, we've tried to take as many as we could. But I'm sure some questions, due to paucity of times and a lack of sight as well, sometimes it's old age, can't see properly. But we will come back to you and forward all the questions to Lakshay, and we'll reach out to you for your answer. So rest assured of that we will reach out for your answer. Thank you so much for asking.
Thank you so much. Thanks.
Thank you, Amit. Thank you for really moderating this very well. Really appreciate it. Time very well spent, and I look forward to more interactions.
Thank you so much.
Thank you so much. And thanks for everyone who joined in. Thanks for your interest in Jubilant. Thanks for your support. Thank you.
Thank you.